Okay, welcome to the deep dive.
Great to be here.
Today, we're jumping right in, really unpacking the latest from, well, a giant in cybersecurity, Palo Alto Networks.
Yeah.
We've got their Q4 numbers, the full fiscal 25 picture.
And their guidance for fiscal 26, which is definitely generating some buzz.
Yeah, it's more than just spreadsheets, right? It's about, the health of this critical industry. It affects pretty much everything digital.
Exactly. We'll dig into the key numbers, yeah, but also what surprised the market and the big strategic moves they're making. It's all about how they're adapting.
All right, let's get into it then. Fiscal Q4 2025 ending July 31st. What were the headline numbers?
Okay, so for Q4 25, total revenue was up 16% year over year, came in at $2.5 billion. That basically met Wall Street targets.
Met targets. Okay.
But here's the interesting part. Non-GAAP net income per share. That jumped 27% to 95 cents. And that significantly beat the analyst estimates, which were around $1.89.
So solid beat on the profit side then. That's
Yeah.
pretty significant.
Definitely. Shows good operational control, not just top-line growth.
And just quickly, for listeners maybe less familiar, that non-GAAP figure, it's pretty standard in these tech reports, right? What's it telling us?
Yeah, good question. Very standard. Non-GAAP, it basically adjusts for things like stock-based compensation, maybe some acquisition costs, stuff like that.
Okay.
It's meant to give you a cleaner view of the, let's say, core ongoing profitability of the business. Investors watch it closely.
Got it. Clears out some noise. So beyond the headline profit beat, what about those other metrics they always talk about, like next-gen security ARR and RPO?
Right, crucial metrics, especially for future visibility. So next-generation security AR, annual recurring revenue, that surged 32% year over year.
Wow, 32%.
Yeah, hit $5.6 billion. And that actually beat estimates, too, which were closer to $5.55 billion.
Okay.
And then RPO, remaining performance obligation, basically their contracted backlog, that also grew impressively, up 24% year over year to $15.8 billion.
Also beating estimates.
Also beating estimates, yeah. The street was looking for about $15.26 billion there. So strong forward indicators.
So strong growth, beating on profits, beating on these key future metrics. What did Nikesh Arora say about all this? What's the story behind the numbers?
Well, Arora, the CEO, he really hammered home this idea of a market shift. He basically said customers are realizing that having a patchwork of security tools just doesn't cut it anymore.
Fragmented defense doesn't work.
Exactly. He argued customers are choosing Palo Alto Networks because their platforms work together, offering, and I'm quoting here, superior near real-time outcomes and the efficiency our customers need.
Efficiency being key there too, I bet.
For sure. And he pointed out they ended the fiscal year with RPO growth actually accelerating, and they crossed that $10 billion revenue run rate mark.
10 billion run rate. That's a milestone.
Yeah. Positioning them, as he said, for sustained growth ahead.
Makes sense. It's that integration story.
Yeah.
Less about individual boxes, more about a system that works together.
And if you zoom out to the full fiscal year 2025, the picture holds up. Total revenue for the year grew 15% to $9.2 billion.
Still strong double digits.
Yep. And full year non-GAAP EPS was $3.34, up 18%. Consistent performance.
I also saw a mention of them being a Rule of 50 company for the 5th year running. That sounds impressive, but what does it actually mean?
Yes. The CFO, Deepak Alecha, highlighted that. The Rule of 50, it's kind of a benchmark for software and tech companies.
Okay.
It generally means your revenue growth rate percentage plus your free cash flow margin percentage adds up to 50% or more.
I see. So it balances growth and profitability.
Exactly. It shows you're not just growing, but growing efficiently and generating cash. Doing that for 5 straight years is pretty commendable in this space. Shows real financial discipline alongside that growth.
Definitely a sign of a healthy, maturing business. Okay, so that's the look back. Now, this is where it gets really interesting for investors, right? The forward guidance. What did they project for fiscal Q1 and the full fiscal year 2026?
Right, the outlook. So for Q1 26, they're expecting next-gen security ARR between $5.82 billion and $5.84 billion.
Which is about what kind of growth?
That implies about 29% year-over-year growth. Still very strong.
And total revenue for Q1?
They're guiding for $2.45 billion to $2.47 billion. That's around 15% growth year over year for the quarter.
Okay, solid start to the year projected.
Right.
What about the full fiscal year 26 picture? That's the big one.
For the full year, FY26, they're projecting total revenue between $10.475 billion and $10.525 billion.
And how does that stack up against what the market was expecting?
It actually comes in slightly above the consensus estimate, which was around $10.423 billion, so positive signal there.
Good. And the other key metrics for the full year, ARR and RPO.
Yeah, next-gen security ARR expected to land between $7 billion and $7.1 billion. That's 26% to 27% growth.
Still very strong growth in that core area.
And RPO projected to be between $18.6 billion and $18.7 billion, again, beating prior estimates.
So the guidance looks solid, beating expectations in key areas. Suggests they're pretty confident about the pipeline.
It certainly seems that way. And on the profit side, they're guiding for a non-GAAP operating margin for FY26 between 29.2% and 29.7%.
Healthy margins.
Very healthy.
Right.
And diluted non-GAAP EPS projected between $3.75 and $3.85. Plus, they expect adjusted free cash flow margin around 38% to 39%. So continued focus on efficiency and cash generation.
Strong numbers all around then. Okay, so we have great results, strong guidance, but why? Let's dig into the strategy. What's really driving this? You mentioned platformization earlier.
Yes, that's really the core of it. It's the strategic push towards unified platforms. They specifically called out a higher mix of software within their traditional network security business.
Driven by what kind of products?
Things like SaaS Secure Access Service Edge, which is, fundamentally changing how network security is delivered, especially with remote work.
Right, moving security closer to the user.
Exactly, and also Prisma Access Browser, giving organizations a secure browser for accessing resources. Demand for these integrated software solutions is high.
And they're seeing customers actually consolidate onto their platforms.
Apparently so. They reported a record number of net new platformizations in Q4. That means customers are actively choosing to consolidate multiple security functions onto Palo Alto's platforms.
Any examples?
They mentioned some big deals, including one worth up to $111 million where the customer adopted multiple platforms. That's a huge validation of the strategy.
Definitely. So it's customers voting with their wallets, moving away from juggling dozens of point solutions.
Precisely. And it's not just network security. Their core tech segment, focused on the SOC, the Security Operations Center, is also gaining serious traction.
That's where their AI comes in, right? With XIM.
Exactly. XIM is their AI-driven platform for SOC transformation. It aims to automate a lot of the detection and response work. They now have around 400 XIM customers.
400. How does that compare?
More than double where they were a year ago. And the average ARR per XIM customer is over $1 million.
Wow. That's significant recurring revenue.
Very. And this ties into how they think about security coverage. They mentioned peacetime and wartime security.
Right. You mentioned that. What's the distinction there?
Think of peacetime as your everyday, proactive security posture. Vulnerability management, threat intelligence, keeping things locked down.
Okay, the constant vigilance.
Right. Wartime is when an attack is actually happening. It's about that rapid, automated detection and response to contain the threat and minimize damage. XAM plays heavily into that wartime scenario.
Makes sense. Covers the whole life cycle.
Yeah.
Now, how does the big news, the CyberArk acquisition, fit into this platform strategy?
Yes, the CyberArk deal. Expected to close later in fiscal 26. It fits perfectly into the multi-platform vision. Palo Alto Networks sees identity security as absolutely critical going forward.
Because of AI agents and things like that?
Exactly. As more non-human identities, like AI agents, access systems, securing and managing those identities becomes paramount. CyberArk is a leader in that space, particularly privileged access management.
So it fills a key gap in their platform.
Fills a gap and secures what they see as a critical control point. They believe adding CyberArk will really strengthen their overall platform offering and help them achieve even higher margins down the line, targeting over 40% adjusted free cash flow margin for the combined company by fiscal 2028.
40% FCF margin. That's ambitious, but it shows the strategic importance they place on this deal.
Yeah.
Bolstering both peacetime and wartime capabilities, it sounds like.
Absolutely. Identity is foundational to both.
So wrapping this up, we're looking at a company firing on, well, pretty much all cylinders, wouldn't you say? Strong Q4, solid full year 25.
Strong financial.
Beating expectations, guiding higher for 26, and it all seems underpinned by this clear strategic bet on integrated platforms.
Yeah, the platformization strategy seems to be resonating strongly with customers who are just overwhelmed by complexity and looking for more effective, integrated solutions.
And as you said, with AI driving both new threats and new defenses, that need for a unified approach probably only gets stronger.
It really feels like an inflection point. The old way of doing security just isn't sustainable. Consolidated, intelligent platforms are likely the future.
It really makes you think, doesn't it?
Yeah.
With AI speeding everything up, the attacks, the defenses, how fast will we see the whole industry shift towards these comprehensive platforms? And you have to wonder, what does that mean for all the smaller niche security players out there? What really stands out to you as the biggest takeaway for how companies need to think about their defenses right now?